Somebody just told you they have a strategy that lets you pay zero taxes completely legally, and you probably smiled and leaned in a little. And honestly, that reaction is exactly what they're counting on. The promise of zero taxes is one of the oldest hooks in personal finance, and it works every single time because none of us actually enjoy writing that check to the government. Here's the thing though, the math behind these claims is almost never shown up front, and that absence of transparency should set off more alarms than a midnight smoke detector. We're talking about a space where one misread rule, one missing form, or one aggressive interpretation of the tax code can turn your zero tax strategy into a six-figure penalty with interest. Think of it like someone telling you they found a shortcut through the mountains that saves 3 hours. Sounds incredible until you realize they've never actually driven it in winter, and you're the one behind the wheel. The tax code in this country runs to roughly 10 million words, and the people selling you simplicity are often working from a 2-page summary. Now, to be fair, there are legitimate strategies: depreciation, cost segregation, opportunity zones, Roth conversions, and real estate in particular offers some genuinely powerful tools that high-income earners use every single day. But here's the irony. The people who actually benefit from these strategies are usually the ones who hired a CPA, ran the projections, and understood exactly what they were trading and when. The behavioral trap here is potent. Our brains are wired to accept good news without scrutinizing it the way we scrutinize bad news. When someone says, "You'll pay more in taxes next year," we demand receipts. But when someone says, "You'll pay zero," we nod and reach for our checkbook. That asymmetry is a vulnerability. Historically, every tax avoidance wave follows a predictable arc: bold claim, rapid adoption, IRS scrutiny, rule change, and a wave of confused investors wondering why their accountant is suddenly sweating. We saw it with certain syndicated conservation easements, we saw it with offshore structures in the early 2000s, and we are watching a slower version of it play out right now in some corners of the short-term rental and cost seg space. The misconception worth addressing head-on is that legal and safe are the same word, and they are absolutely not. A strategy can be technically legal today, aggressively challenged tomorrow, and retroactively penalized the day after the tax code is not a static document, and the IRS has a long memory and a longer audit window. What history actually teaches us is that the most durable wealth builders were not the ones chasing the boldest tax promise. They were the ones who built a strategy around conservative assumptions, verified by real professionals, sized appropriately so that if the rules changed, they weren't wiped out. Discipline in tax planning looks a lot like discipline in investing: boring, consistent, and quietly effective. So the practical lesson is this: before you trust any zero tax claim, ask for the actual projections. Ask which tax code sections are being cited. Ask what happens if the IRS recharacterizes the income. And ask what your exposure is in a worst-case audit. If the person pitching you cannot answer all 4 of those questions in plain English, you have your answer already. There's also something philosophically worth sitting with here. The goal of smart tax planning is not to pay zero, it's to pay what you actually owe and not a penny more, which is a very different energy. One comes from fear and fantasy, the other comes from knowledge and precision. And those two starting points produce very different outcomes over a 20-year horizon. The people quietly winning this game are not the ones in the loudest rooms at the conference. They're the ones who found 1 or 2 legitimate strategies, stress tested them with their CPA, applied them consistently across years, and compounded the savings into real assets. That's not a sexy headline, but it is a real result. We should also acknowledge that some of the most powerful tax strategies genuinely are available to everyday investors, especially in real estate, but they require you to qualify, to hold correctly, to document obsessively, and to have the right professional team in place. The strategy is not the secret, the execution is. So here's where we land. Trust the math more than the promise. Trust the professional more than the pitch. And size your exposure so that even if something changes, you're not rebuilding from zero. Conviction is not a tax strategy, verification is. The beautiful thing about getting this right is that you stop being afraid of taxes and start being strategic about them. And that shift in mindset alone is worth more than any single deduction. Comfort with the outcome comes from preparation, not from hoping nobody looks too closely at your return. And if you're ready to start building a real strategy around real assets, whether that's real estate investing, connecting with qualified lenders, or finding the right contractors for your next project, check out our links in the description below.